Good morning and welcome. I'm Mohini Naidu, investment analyst at Nedgroup Investments, and it is my pleasure today to welcome Stephen Romick of First Pacific Advisors. Steve is the co-portfolio manager of the Nedgroup Investments Global Flexible Fund, a broad mandate with the flexibility but not the obligation to invest across asset classes, industries, and regions. Without further ado, Steve, a very warm welcome, and over to you.
Thank you, Mohini, and thank you all for taking the time to listen today. We at First Pacific Advisors and our contrarian value management team appreciate the long partnership we've had with Nedgroup and its clients. We manage the Nedgroup Global Flex Fund in a manner intended to provide equity rates of return while avoiding permanent impairments of capital. To accomplish this, we operate with greater breadth than any other public vehicle of which we are aware. The fund has capital invested in equities at various market caps around the globe, high yield, distressed credits, and more. While we have more tools than most, we only use them when there is an attractive risk reward. Global Flex had net exposure at the end of the quarter of 69.4%, which is adding both the equity and bonds in this portfolio. That's marginally lower than the 70.5% exposure at the end of the first quarter. While exposure is lower, though, that's more noise than anything else. And importantly, given that stocks have declined as much as they have, this small decline in exposure doesn't reflect the greater activity when you scratch below the surface, including 4 more positions today than we had at prior quarter end. As always, we remain flexible, taking advantage in 2020, by buying hard-hit companies that were hurt by the pandemic. And when those companies rebounded, we reduced exposure to those and added exposure to some of the more controversial, larger capitalization technology companies that offer both more growth and lower valuations than the broader stock market average. Higher yielding corporate debt investments have also begun to make its way back into the portfolio. And we have also actually revisited an old friend that we had said goodbye to not terribly long ago, and now have bookings.com in the portfolio again. The fund's asset allocation hasn't changed much since the first quarter. Financials and technology, which fall both in information technology and communication services category, continue to be our largest sector exposures. Relatively speaking, markets continue to trade at lower valuations outside of the US. Given that one might expect more non-US companies in the portfolio, however, we would argue that the US has more higher quality growing companies with bigger moats than any other country. Owning, for example, a slower growing European company that trades at a lower valuation than, say, a Google would not be interesting to us. Nevertheless, we continue to find attractive opportunities outside the US, which explains the 36% of the fund that is foreign domiciled, excluding the SPAC investment that we have. Note, though, that 55% of the revenues of companies held in the portfolio are derived from outside of the United States. The Global Flex Fund declined 10.8% in 2022's second quarter and declined 13% in the last year. Protecting capital better and outperforming its performance indicator and MSCI World in both periods. The decline in global equity indices was broad-based, leaving little unscathed, with energy as one of the few exceptions, as rising interest rates, high inflation, fears of a weakening economy, and more circumspection when it comes to funding the many money-losing companies in the hope that they will one day become profitable. Even with this recent volatility, equity markets in the aggregate are not technically in a bear market, as defined by Vanguard as being down at least 20% for more than 2 months, though many companies, as we know, have suffered far deeper declines. We at First Pacific Advisors are genetically predisposed to leaning into price weakness, especially should the current negative trend continue, which is made easier when the fund has held up relatively well in this period. In the trailing 12 months, Global Flex's top 5 performers contributed 2.4% to its return, while its bottom 5 attracted 5.3%. We believe that some of these ups and downs might prove ephemeral, but we address where our thesis is being validated or where it might be broken. Glencore, the largest contributor in the last 12 months that you see here at the top of the trailing 12 months performance contribution chart, is one of the largest globally diversified companies operating both industrial and marketing businesses in the commodity sector. Global flexible first purchase Glencore at a single-digit multiple of free cash earnings. The opportunity presented itself when investors were less willing to own commodity-sensitive businesses in a period of low inflation. In just the last 4 years, earnings have more than doubled, but its stock has increased less than 50%. So it still trades at a single-digit multiple of free cash earnings. While more appreciated today, its low valuation justifies its continued presence in the fund. The biggest attractor in the last 12 months, the two cable companies we own that I'm pairing together and making that statement, and I'll address that as we move further on in this presentation. Importantly, using consensus estimates, the fund trades less expensively than the market and is growing faster, a setup we prefer. The look-through PE of the fund's holdings trades at 14.7 times trailing earnings and just 12.6 times forward earnings. These again are based on consensus estimates, not our own estimates. This compares favorably to the S&P 500 that trades at 19.8 times trailing and 16.5 times forward earnings, and the MSCI World that trades at 16.8 times trailing and 14.6 times forward. So again, the portfolio is trading at a lower PE on trailing and projected, and is expected to grow faster, based on consensus estimates. We have seen nothing but bad news afflicting tech companies, causing precipitous declines in their stock prices, particularly those companies that are still in their early years with business models that have yet to be optimized. Bad news, breeds fear, and fear can create, opportunity. Some of these companies had raised money to fund their growth via convertible bonds, initially with yields of 1% and lower. With the conversion price now well out of the money due to the decline in their stock prices, we have begun buying bonds into the quarter with a 9.3% yield to maturity, and maturities that are only a few years away, so there isn't a lot of interest rate risk. These bonds possess some optionality should the underlying businesses be successful, and the market rewards them with a higher stock price. And that should then translate into a higher bond price, given that they're convertibles. This offers the outside chance that the convertible feature might pay off prior to maturity. The average yield to maturity of these bonds is a couple of percentage points at 9.3% higher than the U.S. High Yield Index and more than 6 points better than U.S. Treasuries. We hope to find further opportunities in this space. Another example of our leaning into fear is our investment in the U.S. cable industry. These investments have underperformed in the last year, but still trade well above our cost. The industry has been plagued by fears of video cord cutting and competition from 5G and fiber to the home. This has allowed us to buy and continue to hold both Comcast and Charter Communications. These businesses trade at reasonable valuations and should have tremendous growth in free cash flow over the next decade. And we expect that they will allocate free cash flow in the best interest of shareholders, given that they are controlled by owner-operators. In just the case of Charter Communications, for example, in the next few years, they should deliver more than half of their market cap back in cash. That's a pretty terrific setup, an environment where these fears here, we believe are overstated in terms of what they're going to be able to deliver in the future, even in the context of that. For video cord cutting, for example, is something that actually every time somebody cuts the cord and goes to streaming, it actually isn't really negative to the earnings of these companies and the cash flow of these businesses, given the incredible capital intensity that exists in video cord, on the video side of the business. And in the case of 5G competition, that just isn't delivering the speeds that are necessary to be on this conference call, for example, without worries about being dropped. So this call is being held via South Africa and Los Angeles, and I wouldn't take the chance of running that with on a 5G network. And with respect to fiber to the home, there certainly is more competition that is coming through from that, but that's not something that we expect is going to provide the kind of competition, given the large capital investment budgets and the long lead times. So we have a good window into this that is going to hurt cash flow in the sustainable future. So hurt cash flow in the foreseeable future, not sustainable future. So it's, again, a position that we continue to be, excited about, continues to be a sizable position in the fund. We are all now seeing higher interest rates, something to which we've been unaccustomed to these past 4 decades. I would argue that this downward trend to zero cost of capital has been the single greatest driver of global stock market returns. Some analyses suggest as much as 40% of the market's returns over the last few decades have been due to lower interest rates. A low discount rate increases the value of the future stream of cash flows, as well as pushes terminal values multiples higher, which in turn drives equity prices higher. In addition, while bonds yield so little, even more than they have though, they still are very low yields historically, and this investors have put on more risk in a quest for return, tilting their portfolios away from bonds and towards stocks. We also have inflation that's running at a 5-decade high. When I first started, preparing thoughts, remarks for this conference, it was at a 4-decade high, but the recent, marks have placed it even higher. U.S. inflation was 7% in 2021 in the U.S., a 4-decade high, but is now running even hotter at more than 9%. While this chart that you see in front of you only depicts the U.S., the Eurozone has also recorded its highest inflation rates since the monetary union, running north of 5%, today. Emerging markets have also had very sharp inflation increases, with some countries recording double-digit levels. Inflation has, however, remained generally low in the largest Asian countries. It remains to be seen where inflation levels out and how individuals, companies, and governments will manage through both high levels of inflation as well as higher interest rates. We suspect that it's going to be a bit of a bumpy path, and there'll be more opportunities to put our cash to work as we move forward. That's the end of my prepared remarks. I'll turn it back to you, Mohini, for some questions.
Steve, thanks very much. I think to begin with, maybe we can refer back to the slide where you discussed the thesis for your cable position in the fund, and where you outlined some of the headwinds that these sectors face and the concerns around that. And yet it remains a position that you're quite constructive on in the Global Flexible Fund. So given that all of this is publicly available information, what is different about the way you and the team are looking at this and analyzing this information that others might not be able to see?
It's a good question, because it really speaks to process. And for us, it's about being studious and trying to understand businesses and industries. And so as we do that, and as we hire experts to help us understand different industries and businesses, and we have our own journalist, a qualitative analyst on our team, who used to work for Fortune magazine in the Shanghai office. We actually try and uncover the kinds of information that might give us a little bit of an edge in understanding these businesses, or at least, if not an edge against, it at least gives us a strong understanding so we can make the right decisions. So what we try and get to every time, and we read with intention, we study, all of the industry publications, the information from the competitors, from this company, et cetera, from whatever company we're looking at, and we try and read it and read all this information with this idea of looking for the 1 to 3 things that are really the key drivers, because of these businesses. Because you're right, there's so much information out there, one can get buried. So if you really are looking for the 1 to 3 things that are the drivers of that business, then that should help maximize your time and be more efficient, so that one's focus, as ours is entirely on those drivers of the business, businesses, future success or failure. And those are the key performance indicators we're always looking for, that which will validate our thesis. What information has been coming out that is confirming or non-confirming, to the thesis in the recent number of months? Does something change our longer term view? And to be able to focus so specifically on what those few things are that are the drivers of the business, allows us to get through, each day with clarity and help make the best longer term decisions.
Thanks, Steve. I was actually up in Johannesburg recently meeting with investors of the Global Flexible Fund. And one of the questions that came up most frequently, and you have alluded to this a little bit in your presentation, has the recent market volatility not presented more opportunities to be fully invested, to use up some of that cash, to deploy some of that cash. We've seen over the last 6 months, the S&P, for example, is down something like 20%, yet we still have an average of around 30% in cash in the portfolio. Have you been able, sorry, carry on?
No. It's a good question. So what you've seen is you've seen a shift in the portfolio. So the portfolio has seen, although there's been the market's down, 20%, you've seen a lot of movement within some of these companies are down a heck of a lot more. And what we have done within this portfolio has begun to shift the portfolio, as I mentioned in the prepared remarks. It's been shifting from these more traditional, value companies that were very, pandemic sensitive to many of these better, higher quality, growing global businesses. And so you've seen that portfolio shift that's happened, but even 20%, as we know, is not a huge decline. That, in fact, we've hardly even been down here, for that long, such that, as I pointed out in our prepared remarks, it's not this market decline does not yet even classified as a bear market, which by the traditional definition is being down at least 20% for at least 2 months. So that hasn't even happened. So the world isn't out of the woods. We haven't figured out how to wrangle this high level of inflation. We're not really sure where inflation will level out. Not really sure. We just really have no idea. But governments and central banks don't have a strong idea. Well, they think they have an idea, but we'll see how effective they will be in managing this. And they're trying to do it through high rates today. But at the same time, we're already seeing companies and industries being negatively impacted by that. I mean, today, right? We just in the U.S. There's a publication that came out with the consumer sentiment for U.S. housing, and it's as negative as it's been in a decade. So we suspect that this is not done yet, and it's not because we're making a top-down decision. Our decisions are made from the bottoms up. As we see opportunities that meet our risk reward, we will be buying those businesses, and you'll see that cash get drawn down. And that is the key for us, is whether or not those individual investments offer the attractive risk rewards. We have positions in the portfolio that we've begun to build and that we expect to lean into in future market weakness. Let's take CarMax, for a moment as an example. CarMax is the largest U.S. auto dealer, used auto dealer, and they're in the wholesale business, they're in the retail business, and they also have a finance company. Well, that finance company will get hurt in a recession if that's in the cards. And so we want to be, and not that we're calling for a recession, but we want to make sure that we have the buying power to buy these companies, as they or if they decline in price. And so you would expect to see in continued market weakness and a longer downturn than what we've had, thus far, more of that cash put to work.
Steve, I'd love to be able to continue this conversation with you, but we just have time for one last question. Now, investors on the ground, man on the street, has a very different perspective of the current events, rising inflation, rising interest rates, threat of a recession, than you might as a portfolio manager. Are there any insights that you can share with us that might perhaps help us to better manage our emotions in this turbulent environment that we're experiencing?
Yeah, so for us, what we always really focus on is again, those 1 to 3 things. And if we focus on that and we understand what the world will look like, not tomorrow or even later today, but next year, 3 years and 5 years, if one firmly looks at what the future is going to bring to these businesses and ask the question, will these businesses grow over the next 5 to 10 years? What will the competitive set look like, which might impact that growth? And if they're going to grow, generate free cash flow, do the right thing with that free cash flow, and they are reasonably valued in a host of different circumstances, including different types of economies and in different levels of interest rates, 5 to 10 years from now, then that, gives us, the comfort to sit through today without any great stress. Managing emotions becomes much greater if you look at the market movement and volatility and allow your emotions to move up and down with that. But these are all blips in moments in time. And if you look back, if you go forward, 5 to 10 years and then look backward to these moments, you'll see that they are all just moments. We've had so many of them, over the last 50 years, whether it be the energy crisis in 74, the internet bubble, the great financial crisis of 08, 09, this recent pandemic. These things all pass. And these businesses, you'll see the better businesses grow through it. Microsoft is better today than it was 10 years ago. It was better 10 years ago than it was 10 years before that. So if you pay the right price for these things, you should do quite well. And one last piece of information that I would just also leave you with is if you do this in a good way, we should be very effective in make the journey a little bit more of a manageable journey as value investors and putting that cash to work, over time, which is why, at least it doesn't always happen this way. There's a lot of active share in the fund because we don't mimic the market, but at least, from the market peak, in early January, the portfolio is down 13% and change, and the indices from the market peak in January are both down, 20%. Plus a little bit. So we've actually outperformed our exposures, in that time, and that gives us, as I said earlier, the with the cash and with the psychological benefit of having performed relatively well in this downturn, to put that capital work in the event that there is that future opportunity. And again, we'll focus on the bottoms up, and we look forward to more opportunities.
Steve, thanks very much for sharing those insights with us. Unfortunately, we've run out of time for today. Stay safe and keep well. And we now head back to the Nedgroup studio.